In today's rapidly evolving economic landscape, capital efficiency isn't just a financial metric. It's a pivotal strategy that drives organizational success and economic resilience. As leaders, our focus should not solely be on profits, products, and operations, but also on the smart utilization of capital, a strategy that transcends industries and borders. Capital efficiency is the beating heart of personal finance, corporate finance, and economic performance. Whether you are a government, corporate, or business leader, optimizing the velocity of money can significantly enhance economic and investor returns. This isn't exclusive to financial experts. Every leader has the potential to drive impactful change through informed decision-making and proactive execution. As Einstein so eloquently expressed, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. If we focus on improving the velocity of money, we earn. If we don't, we pay. By focusing on accelerating the velocity of money, we position ourselves to yield returns rather than incur costs. Considering the wise words of Einstein, why do the most vulnerable in society extend credit to the most powerful? It doesn't make sense. But every day, employees go to work, deliver their value, and in the evenings go home, usually empty-handed. Many wait for up to 30 days to be paid. They are creditors to their employers. With families to feed and bills to pay, many turn to high-cost debt. This is the harsh reality for the vast majority of employees around the world. They are effectively forced to sacrifice their cash flow for the company from their first day at work. The same holds true for small and medium enterprises, extending credit to large companies and governments. From an economic standpoint, low-cost debt is being displaced with high-cost debt. Simple capital destruction, inflating costs, suppressing demand, trapping many families and entrepreneurs in an endless cycle of debt. Historically, the concept of extending credit is as old as trade itself, dating back to ancient Babylonia. However, in our fast-paced, technology-driven world, adhering to these age-old conventions is no longer practical. We observe this in the everyday reality of employees and small businesses extending credit to larger entities, often at a significant personal cost. This practice of delayed payment contributes to a destructive cycle of high-cost debt, undermining individual financial stability and broader economic health. Ironically, this inefficiency is passed back in time to the buyer. There is no free lunch. Innovative leaders challenge these outdated conventions. They use capital asymmetry as a weapon to create competitive advantage. Today, I challenge you to get curious about capital efficiency. I invite you to explore how you can apply simple principles to make your company more profitable, competitive, and valuable. Capital efficiency is the responsibility of every leader who produces value for their company or country. Whether you're in leadership, logistics, supply chain, operations, finance, product, marketing, or any function in business or economic policy that creates value, capital efficiency amplifies your results. I'm not a finance guy. If you sum up my entire career, I've been this guy. I built the innovation groups at DBS Bank and AIA Insurance. I've always been curious. I have been fortunate to learn from some of the best global business leaders. My career journey has taken me from agriculture to aviation into technology, banking, insurance, and investment. Universal principles of capital optimization apply. Do you know why technology economics makes addressing capital efficiency a significantly more urgent priority today? Very simply, the answer lies in the velocity of technology and its impact on money. In 1975, Steve Sassoon from Kodak invented the world's first digital camera, producing 0.01 megapixels. In the year 2020, Samsung released a phone camera producing 108 megapixels. Considering this pixel increase over the elapsed 45 years, there has been feature appreciation of 23% per annum. Why that's important is that consumer expectations are for technology products to be better, faster, and cheaper every year. You don't buy a 5-year-old phone because it's obsolete. Feature appreciation plays a critical role in the velocity economics of every business. If you look at the cost side of that equation from a depreciation perspective, the Altair 8800 in 1975 had 1 kilobyte of memory, representing a 1 megabyte cost of $11,378. In 2020, 4 terabytes from Samsung cost $748 at retail. That's a straight line depreciation of 33% per annum over 45 years. The takeaway is this: technology is like sushi. Consume it fast or fresh, or don't consume it at all. This is why the Agile development maxim stipulates if you don't deliver in 90 days, it's waste. These same dynamics apply to money. Time is money. Time is risk. Time and risk are the foundations of finance. Technology arbitrages time. Return on capital equals growth of value over time. Technology doesn't do things that we, as humans, can't do. It just does it more time efficiently. Using technology to minimize time, we can generate superior economic returns. Simply, less is more. If you think of appreciation, that's savings or investment. If you think of depreciation, that's debt. Displacing debt cost with investment returns is a winning formula. These companies displace debt costs with investment returns to create competitive advantage. They understand capital efficiency is as important as operating efficiency and product. Companies with great products and great operating efficiency, but poor capital efficiency, are vulnerable regardless of size. Market leaders have and will fail because they don't focus on the velocity of money. This dynamic is now critical in every industry. Every company is transforming into a tech company. Technology is an increasing cost in medicine, finance, the environment, society, and manufacturing. Legacy is vulnerability. In the auto industry, technology as a percentage of the cost of a car is forecast to rise from 18 to 45%. The velocity of technology demands an increase in the velocity of money. The fast eat the slow. Capital efficiency accelerates growth, return on capital, and investor returns. So, how do you transform? I'll share my story. I began my career as an operations manager in aviation, flying at night as a pilot, building financial models, and automating the business during the day. I've been fortunate to have participated in 2 significant capital efficiency transformations and influenced financial transformation at a number of other leading international corporations and institutions. I'm not a CFO. I'm not commercially trained as a finance person. What I learned, anyone can learn. My first experience in capital efficiency transformation was in 1995 with Dell Computer, where I had the opportunity to learn from a great CFO. In 1995, Dell was emerging from near bankruptcy, as I was told by other early employees. Many had given up their holidays to ensure the company remained solvent. As Tesla's experience with production hell laid the foundation for gigacasting, experiential learning was a powerful catalyst for transformation at Dell. I joined Dell in Asia and headed up product and pricing for the desktop business. Desktops represented about 95% of Dell's business at the time. Compaq was the giant. Dell was the minnow. Compaq was 3 times the size of Dell. Dell's global CFO Tom Meredith gifted me my greatest business lesson. Tom focused Dell on 3 things: profitability, liquidity, and growth, manifesting in the cash conversion cycle. I had no idea what liquidity or cash conversion was then. I became curious. It affected how I priced products for Dell. So what is a cash conversion cycle? A cash conversion cycle measures how efficiently companies transform cost into cash. Simply, companies transform materials into products and services they sell to customers. Supplier credit generates cash. Inventory and receivables consume cash. The net cash is set as a ratio over revenue and multiplied by 365. This calculates how many days a company takes to transform cost into cash. If you look at 1996, Dell had a worse cash conversion cycle than Compaq. Dell required 47 revenue days of cash to operate. By 2000, Tom had transformed the company to a negative 20-day cash conversion cycle, transforming funding costs into capital returns. This shows capital efficiency is more correlated to management action than business model. Dell's business model didn't change. Dell's management discipline did. Tom weaponized capital against Compaq. The impact of this transformation was significant. By displacing cost with returns, Dell grew more cost effectively. Every dollar of growth generated Dell 5 cents of capital to invest, while every dollar of growth demanded Compaq find an additional 13 cents of funding. Dell was generating returns on capital while Compaq was generating cost. Dell reduced the operating capital required to run the business and generated 4 times higher returns on invested capital than Compaq. High growth and high ROIC enabled Dell to enjoy the industry's highest market cap. The velocity of money matters. If Compaq's CFO or leadership team had done what Tom Meredith did, he could have increased Compaq's market cap by $54 billion and changed its fate. In 1997, in the middle of Dell's capital efficiency transformation, I joined Compaq. I tried to communicate why Dell was beating Compaq, but failed to persuade financial leadership. I was a product guy, not a finance guy. Fortunately, I was given the opportunity to prove it directly. I led the Asia Pacific Product Marketing Group for a brilliant leader, Sean Burke, who headed Compaq's consumer division. He gave me my shot. We had a rapidly escalating problem in India. Compaq was number 4 in India, unprofitable and burning cash. Sean asked me to fly to India to fix or close the business. Once I was booked to fly, he graciously advised that closing wasn't an option. It sounded like a one-way ticket. I was motivated to drive a result. I flew over to India to discover the root cause. The Indian leadership team, in no uncertain terms, advised me that it was impossible to compete with the local computer manufacturers. This struck me as illogical. Compaq, the world's largest computer company, had better products, economies of scale, and the greatest purchasing power. I went into the market to observe and assemble the puzzle pieces to complete the picture. I came to the conclusion that it wasn't impossible, just improbable. My first discovery was that we misjudged the competition. The competition wasn't Wipro or other major manufacturers. It was worse. The real competition in the market was the white box manufacturers. The no-name PC dominated the market. Our gap to market was wider than we thought. It shifted my thinking. I returned to headquarters in Bangalore and spent time with the management team, finance, operations, supply chain, procurement, and product. With the learning from Tom Meredith reverberating in my brain, I began remodeling the business in Excel to optimize operating and capital efficiency. I jumped on a plane and returned to Singapore to solve the next puzzle: product. With support from Sean and the hardware and software engineering teams, we redesigned the product to fit our capital and operating efficiency model, preserving the quality our customers valued. Within 1 quarter of the relaunch, Compaq India's market share moved from number 4 to number 1, with high profitability and better capital efficiency than Dell. We had outdealt Dell. We transformed the impossible into possible. In 2000, I joined Citibank. Compaq merged with HP. I tracked HP India's performance for many years, during which it remained number 1 in the market. Prior to producing this presentation, I checked again. 24 years later, HP remains number 1 in India. Dell is number 2. Capital efficiency improves competitive sustainability. The key takeaway is this: you don't have to be a CFO or finance person to make your business capital efficient. You just need to be curious, lead, and execute. In 2021, after working for Riyadh Bank in Saudi Arabia for a year, I flew back to my home base of Japan during COVID. I reflected on how illogical it was that Japan had the lowest cost of capital and yet one of the lowest returns on capital. I wanted to understand why. Despite being a market minnow, I learned that Tesla was more valuable than Toyota. Toyota enjoyed market power, economies of scale, and was world-renowned for operating efficiency. But was it capital efficient? The Tokyo Stock Exchange didn't think so. It warned Toyota to improve capital efficiency. As an industry outsider, I started to apply the same modeling processes I had used at Compaq. I compared Compaq and Dell to Toyota and Tesla. The similarities are startling. Cash conversion cycle, growth, cost of growth, EBIT margin. Most importantly, return on invested capital. As Elon Musk recently told shareholders, efficient capital management is hard. As interest rates in Japan finally begin to rise, Toyota, as the world's most indebted company, will struggle to compete unless it becomes capital efficient. I began to model what Toyota could do to increase the velocity of money. I estimated Toyota could improve EBIT by USD 460 million, not by driving an additional 5 billion in revenue, hiring 13,000 employees, ramping up factories, increasing distribution, and lifting sales targets, but by applying management discipline to become capital efficient. Working smarter, not harder. We ran scenarios to analyze if you could collaborate equitably with your supply chain partners to improve both companies' EBIT by optimizing capital across supply chain balance sheets. We looked at vanilla weaponization of capital by just mimicking Tesla, assuming common suppliers. Toyota would improve EBIT by 2 billion, while Tesla would have almost 3 billion at risk. Tesla's capital was a lot more expensive than Toyota's. Toyota was wasting its capital advantage. To explain it in layperson terms, imagine you're a company and sell $100 of products. But you don't get paid for a year, and the interest rate is 10%. It would cost you $10 in funding while you are waiting for payment. You would net $90. Even if you discounted 10% to get paid on day one, you could use that money to pay down debt and net $99. Velocity matters. Employees are subject to similar dynamics, but usually pay more for debt. Assuming a year for illustrative purposes, pay acceleration for employees has an equivalent impact. If an employee were paid daily, not only would the employee save credit costs, but equally deleverage debt. Velocity of money makes a huge impact. If employees paid their mortgages in Japan daily versus monthly, they would pay a 35-year mortgage off 5 years earlier. That's the power of capital efficiency. In finance, it's about working smarter, not harder. As Tom Meredith proved, it takes discipline. If Japan transitioned from a monthly cycle economy to a real-time economy, we calculate that employee effective income would improve on average by 10% and effective GDP by 20%. Increasing the velocity increases economic metabolism, partially offsetting the slowing economic metabolism of an aging population. This should be the easiest message to sell. But the initial market responses were no. Not unexpected. But most importantly, you now know. This leads me back to another important career learning. Every transformation starts with no. No is the answer when someone doesn't know. No empowers people to take action. Now advances us towards our objectives. If we seek to drive change, we need to enhance learning. Learning enables us to transform no into now. Shared language, learning, and experiences creates culture. If you want a culture of innovation and transformation, empower people through learning. The question to answer is, how can you transform capital efficiency in your division, company, or country? Start with being curious. Every leader has a role to play. I invite you to join this journey of transformation, to explore how capital efficiency can be integrated into your strategies for growth and competitiveness. It starts with curiosity and the willingness to challenge the status quo. The future belongs to those who are quick to adapt and innovate. The fast eat the slow. Importantly, simultaneously solving for ESG and competitive advantage is perhaps the most personally and economically rewarding initiative one can undertake.